£230 every week for the rest of your life. That's what the state pension gets you. But here's the thing, it's not automatic. If you don't know how to claim, when to claim, and maybe even how to boost it, you could be missing out on the retirement that you deserve. In this video, we'll walk through everything you need to know to make the most of the state pension and give your retirement the boost it deserves. Coming up, we're going to look at the new state pension and how it's different from the previous basic state pension. How much do you get from the state pension? How the state pension entitlement works? And what does it mean for your retirement? But first, about myself. My name's Ross Kelly. I'm a soon-to-be Level 4 diploma holder in regulated financial planning from the CII, with the plan to be Level 6 come November. On this channel, I look at common areas of finance that are misunderstood, or even ones that are scarcely known about, with the hope to help build people's confidence in their own finances. These topics are important, and it can be the real difference between you achieving your financial goals and them going up in dust. If you find anything in this video useful, be sure to drop a like and subscribe. It helps the channel massively and helps me reach people that might need it. And be sure to drop a comment as well if you have any questions about anything in the video, or even if you have any topics in finance you would like to see covered in the future, or maybe even just what you had for dinner. I'd like to know. With that, let's get into the video, starting with what even is the state pension? The state pension is a regular income that's paid out to people above a certain age that have a certain level of contributions. We'll get into the details of that later, but so far all you need to know is it's a guaranteed income from the government that's seen as a way to repay the UK citizens for contributing to the economy over their lifetime. As the name entails, the new state pension is relatively new. It came in and replaced the old system in 2016. As you can see from the table to my side here, the previous state pension was very complicated. A lot of moving parts, a lot of extra add-ons. This led to people not really knowing what they were going to get from their state pension come retirement. The new state pension, however, is a lot simpler and a lot more predictable. This has led to a lot more people feeling a lot more comfortable knowing what they're going to get come retirement. In the transition, there was a lot of complications with regards to people who might have ended up being better off as a result of the new pension, but more importantly, people who would have ended up being worse off as a result of the new pension. People had options like contracting out, all these other moving parts. All you need to know is that generally, if you're going to be worse off as a result of the new pension, the government would make up the difference. Again, there are a lot of moving parts when it came to the transition between the two state pensions. It'd be worthwhile seeking out a finance professional if you're unsure where you stand. If you'd like a video going over all the minutiae of the transitionary period between the two pensions, be sure to leave a comment below and I'll try and get that video to you. So how does the state pension work? At the moment, if you're born before April 1960, you'll be able to claim it at age 66. Anyone thereafter, you're going to need to wait till you're 67, and the plan is eventually to get it up to 68, and probably by the time I'm retiring, it's going to be way higher than that as well. The current rate for the state pension in 2025 is £230.25. This is paid every 4 weeks, and the day on which it's paid is actually dependent on your NI number. Just a fun little tidbit. A really important thing to know is that you don't just get the state pension when you hit state pension age. You need to apply for it on the government website. There's a link on how to claim it in the description of this video. You just need to go on, put in your details, and then you'll be able to start claiming it. It's paid on a pro rata basis, so you'll get it like 5 weeks after applying for it. But yeah, you need to apply for it before you start getting paid. A couple quick myths about the state pension. If you move abroad, you might not necessarily automatically be disqualified from claiming it. Depending on the country, you might still be able to claim it. And you do not need to retire to claim the state pension. It's just about your age. You can still keep working and claim the state pension. The state pension increases every year, and it's based on a system called the triple lock, which is based off of 3 factors. It increases based on which is the highest of 3 variables. These variables are average earnings, the CPI index, and 2.5%. So whichever 3 of those numbers is the highest is how much the state pension will increase in the following year. Now, how do you become entitled to the state pension? Well, that's all based on your national insurance contributions. If you work for an employer, most times your national insurance will just be automatically coming off your wage at the end of the month. If you're self-employed, you might need to manually submit your national insurance contributions yourself. The way it works is that to get the maximum amount of state pension, you need a total of 35 years of contributions for your national insurance. For every extra year of national insurance contribution, you'll gain 1 more 35th of entitlement to the state pension, with a minimum of 10 contributions needed to be able to gain anything. So if you only have 9 national insurance contributions, you won't be entitled to any state pension. You need to get over that 10 hurdle rate. The government likes to say that national insurance isn't a tax, but it's more or less the same in every way but name. Your level of national insurance that you need to pay is normally based on your income. Can be a little bit different depending on whether you're self-employed or not. So I'm going to throw up this little table here that shows you just how it works. This graphic's from the CII, gives a good breakdown of national insurance, and unfortunately I became very familiar with it for my exams. And as a quick example, if you were to earn £1,000 a week, the amount of national insurance you would need to pay on that is £58.66, showed by the calculation here. Of quick note, since April 2024, Class 2 national insurance contributions are no longer mandatory for self-employed individuals. So this means it's not required. In some cases, it might still be worthwhile doing the Class 2 contributions. So again, seek out financial help if you're unsure on what you might want to do. There are also options for those who might not be in work at the moment, such as unemployed people who might have just recently lost their job, as well as people who might be caring for another individual. Again, all these details are on the government website, and it's worthwhile checking to see if you're entitled to these credits. If you're coming up to the state pension age and you realise that you don't have enough contributions to get the full allowance, you're able to retroactively add national insurance contributions. This will normally allow you to go back up to 6 years to add in more national insurance contributions to make it so you get more value out of your state pension. Again, like most things in finance, this might not be for everyone. But for most people, most of the time, these contributions are a great return on investment. And we'll just show you in this example here just how much we're talking about here. Right, so we're going to bring the paper up again because there's quite a lot of numbers going on here, and I think it'll be easier shown rather than telling. When making a voluntary contribution, you're going to be doing the Class 3 national insurance. This costs £17.45 per week, or £907.40 for a full year. Now remember from earlier, each extra qualifying year adds 1/35 of entitlement to the state pension. So to work out how much you'll be getting for each extra contribution, we just need to times the 1/35 by the full state pension allowance, which again is £230.25 per week. This works out to £6.58 per week. And again, to put this out into a yearly figure, that'll end up being £342.16 per year for life. So to summarise, you're paying £907.40 once and getting back £342.16 per year every year from the state pension, from the age of 66, or later in my case, until death. To get the break-even point, or the point that we need to survive to the point where we're just making free money, we just divide the two numbers, and this ends up being 2.65 years. All you need to say is that for each contribution, you just need to survive 3 years into claiming your pension to make your money back. And after that point, it's all profit. And not just profit, index-linked guaranteed profit for life. So let's assume someone lives for 20 years after they claim the state pension. So they lived to an age of 86. They would have gotten that extra £342.16 for 20 years. That would total £6,843.20. And to work out the return on investment from this, all we need to do is take away the original cost and then divide it by the cost as well. That gives us a return on investment of 654% over 20 years. And realistically, that's better than more or less any investment, especially considering how secure it is and how guaranteed it is. And again, remember, this increases with a triple lock every single year as well. So that investment will continue to grow every single year with inflation or whatever might be higher of the three. And as such, the longer you live, the better return you're going to get from this. You can check your entitlement to the state pension on the government website. I've left a link to it again in the description, so if you want to go check how much you've currently accrued, you can go do that yourself. I also thought it'd be worthwhile touching on how the state pension is taxed. Now, while it is taxed as an income, it's effectively not taxed, as it goes to the very bottom of your earned income, and as such it never reaches the band to actually get taxed. But what it will do is push up your other earnings and make it so that they are more likely to get taxed. There's also an option to defer the state pension. This means that you delay taking it for a higher state pension in the future. The way this works is that you get 1% increase to your state pension for every 9 weeks that you defer. So it ends up working out to be just below 6% per year. It used to be the case that you could take a lump sum, but since the new state pension was introduced, that's no longer an option. Whether it's worthwhile to defer the state pension or not definitely depends on the person. 5.8% isn't really that great a return, and it could be used worthwhile in other things like investments or paying off higher interest loans. But again, if you're not sure, it's definitely worthwhile seeking out a professional to see what might be best for you in your circumstances. The state pension is a great tool for any retirement. It's guaranteed income that increases over time. You can't really ask for a safer option. However, moving forward, it's quite clear that that level of generosity, especially with a triple lock, is likely not going to last very long. It's already been widely spoken about how the state pension might not be sustainable in its current form. How they tackle this, I'm not sure. There's going to be no winners here when it comes to changing the state pension, but at the moment it definitely seems to be unaffordable and some things will likely need to change. And if I was a betting man, I would probably put it on some changes to the triple lock, maybe a bit lower on how much it's guaranteed to increase every year. It is important to remember that while the state pension isn't a bad level of income, it's certainly something you can't base your entire retirement around. Further planning is definitely needed, using stuff like SIPs, ISAs, pensions, all that type of stuff to make your retirement as comfortable as possible for yourself. The state pension is kind of just like a little cherry on the top, a nice guaranteed income that can be used just to buy the essentials, pay the bills, all that type of stuff, and let the rest of your retirement savings let you live in luxury. Now there is a couple details missing in this video, stuff relating to maybe inheritance, spousal transfers, divorce implications, all that stuff. They're a bit more complex and case by case, so I didn't think it'd be worthwhile putting in these videos. But again, if you want to see any of these types of topics covered, be sure to let me know in the comments below. I've also left some links down below that will point you towards any extra info you might want to learn about the state pension. And that just about wraps up this video. Thanks for making it to the end. Again, if you found anything in this video useful, be sure to leave a like and subscribe. Helps me out a lot and lets me know that you're liking the content. This is my second time filming, so I think it went a bit better than the first time. A bit smoother. Definitely a fair amount of outtakes, but you know, process is starting to smooth out a wee bit. But yeah, thanks again for getting to the end. If you'd like to learn anything about ISAs at all, you can go ahead and check my first video. And yeah, until then, I'll see you around.